Today we are going to study accounting standard 15. Accounting standard 15, employee benefits. This accounting standard 15 came into effect 1st April 2006. Accounting standard will applicable for old syllabus and for new syllabus also. Applicable for level 1 enterprises. However, relaxation is there depending upon the employee. If there is a more than 50 or 50. What is level 1? Preceding financial year more than 50 crores of turnover. That is level 1. That is the applicable. So for that, level 1 companies AS 15 is applicable. Then employee benefits. What is employee benefits? Generally we say all forms of consideration given for the services rendered by the employee to the employer. It includes all forms of consideration for the services rendered, including accrued during the employment, but payment may be later. So for this purpose, accounting standard 15, employee defined as an employee who may provide service to entity. So this can be divided, this employee can be divided full time, part time, permanent, casual or temporary basis. Also includes directors, whole time director, management personnel. So these are the employees, definition of employees. The following can be considered for establishing employee-employee relations. There is a employer-employee relation should be there. What is employment contracts? There is a two type of contracts. Contract for service, contract of service. Contract of service, in this employer has the controller. He has the control on the employee. He has the performance task, performance standards, what to perform, how to perform, form and manners. In this service given to outsider, in this will not be applicable as a employee. This will be employee. So this will be employment contracts, contract of service. Individuals are considered employees for legal security purpose. There is a huge amount of direction provided by the employer and the necessary tools have been provided by the employer. Service have to be performed at a location provided by the employee. Next comes short-term benefits. So these benefits according to AS 15 can be divided into 4: short-term benefits, long-term benefits, temporary benefits, and the post benefits, that is the termination benefits. So what is a short-term benefit? Short-term benefit. Short-term benefits due within 12 months from the year end. So they provided services in this financial year 12 months due with in this period. So within 12 months, that's why it is short short term within 12 months. Example: wages, salary, etc. How to recognize? This should be recognized as expense and liability in the year of service or accrual basis. For this, no discounting. You know discounting? Discounting factors. No discounting factor or those benefits which are payable within 12 months. That's why it's called as short term. These expenses are accounted straightforward, so no actual assumptions are required, so no discounting is required. Salary, wages, regular payments, composition of short term absence, sick leave, annual leave, bonus, profit payable within 12 months, non monetary benefits, medical insurance, housing. The general criteria of the standards lays down that an enterprise should recognize as an expense. Unless another accounting standard permits different treatment, undiscounted amount of all short-term benefit attributed to a service that has been already served in the period, and any difference between the number of expenses so recognized and the cash payments made during the period should be treated as a liability or a prepayment assets as a payment. So important point is it is a straightforward undiscounting, no discounting is there. Now come up to post employee benefit. So we said 4 types: short term, long term, post employee benefit, temporary benefits or a termination. Now post employee benefit, this is due after the completion of the service, so it will be liable after the completion of the services. Example: gratuity, superannuation, etc. Time difference may exist because this is the post employee benefit. Service should be completed, that's why there will be a time difference. Therefore time value of money should be considered. Post employment benefit, the accounting treatment and disclosure for post employment benefit plan rely upon whether it is a defined contributor or an defined benefit plan. So this can be two types: defined contribution plan, defined benefit plan. Defined contribution plan, in that responsibility is limited to the contribution only, that's why it is defined contribution plan. Responsibility is limited to contribution only, no further responsibility, no actuarial and investment risk on entity. So no risk on the employer, no actuarial, no investment risk on the entity. Contribution is defined, responsibility is limited to contribution only. Recognize expense and liability in the year of service, that is on accrual basis, no present value calculation in the case of defined contribution plan. Pays fixed contribution, it is limited into separate fund, will no obligation to pay any amount in future. Actuarial and the investment risks falls upon the employee, not upon the entity, not upon the employer, as there might be chance that the benefit will less than the expected or the assets will be insufficient to meet expected benefits. So all the risk will be on employee, not on employer. In case of defined benefit plan, first one is a defined contribution plan, now defined benefit plan. Responsibility is to provide the agreed benefits after retirement, so there will be agreement accrued during the services, but payment after the retirement, but there will be agreement benefit, agreed benefits after retirement, payment after retirement. Actuarial risk, what about the investment risk, actuarial risk, it is with the employer, that is very important. In case of defined contribution plan, it is with the employee. In case of defined benefit plan, it is with the employer. Time difference exists, so time value of money should be considered in the case of defined benefit plan. Present value computation required, discounting factor required. How to calculate that, we will see that one. Defined benefit plans are the post employment benefits which are not covered by the defined contribution plans. Under this plan, the actuarial and investment risk fall upon the employer, and it is fall upon the employer. Very detailed actuarial calculation is performed to determine the charge. So in this case, present value should be calculated. Third point, third types of benefit, other long-term employee benefit. This is due during service period but paid after 2 years from the year end. Example, any example, silver jubilee, gifts, etc. Same as post employment benefit. There are few other long-term benefits which our enterprise gives to its employees. Some of them are long-term paid leave such as sabbatical leave, jubilee, other long-term services, long-term disability benefits, profit or bonus which is to paid employee after 12 months for period in which the service was rendered. In case of profit or bonus, after 12 months, usually 2 years. Termination benefits. This is after services, either a VRS. If not paid immediately, no present value calculation. If they're paid immediately, no PV calculation. If it is not paid immediately, PV calculation will be there. Otherwise, bring to the present value, provide the same. Termination benefits are those benefits which result in payable if it is an enterprise's decision to terminate an employee benefits, or it is the decision of employee to accept voluntary redundancy in exchange of the benefits. Example, payments made under voluntary retirement scheme. Termination benefits have to be recognized by enterprise as a liability or an asset only when the detailed formal plan for termination is approved. Reliable estimate can be made of the obligation to be paid. That is the termination plan. So this is very important. Now come to the accounting treatment. The accounting treatment for the employee benefit must be recognized in the balance sheet of the enterprise. Yes, correct. The amount to be recognized as defined benefit liability should be the net of totals of the following amounts. In case of defined benefit, present value of the defined benefit obligation at the balance sheet minus any past service cost not yet recognized, this should be minus fair value at the balance sheet date of the plan asset, if any, out of which obligation are to be settled directly. This will give the amount that should be shown in the balance sheet. If the fair value of the plan asset is higher than the liability, then it gives rise to net asset. That is simple. If it is asset is more than the liability, it gives net asset. So present value of the should be calculated, then minus any past service cost yet not recognized, that should be deducted, and this also should be deducted. Fair value of the at the balance sheet date of the plan assets, out of which obligations are to be settled directly. As per AS 15, in such situation, the enterprise should measure the resulting asset at the lower of the amount so determined or the present value of economic benefits available in the form of refunds from the plan or contributions. As per ICA, the standard identifies various components of defined employee cost, current service cost, interest cost, expected return on any plan asset, actuarial gains and losses, past service cost, effects of any settlements and or curtailments. Disclosures. If enterprise is uncertain about the number of employees who will accept the number of termination benefit, it is unexpected, uncertain, then there will be contingent liability that will be shown as per AS 29. This is as per AS 15. We have to study AS 15. So AS 29 mentioned in AS 15. If an enterprise has to disclose the information about the termination benefits for key management personnel, then it has to be disclosed as per AS 18. Actuarial assumption and treatment. An enterprise should consider the actuarial assumption only if it is unbiased and mutually compatible. Then only they should consider actuarial assumption. The actuarial assumption have to be treated as an enterprise's best estimate of the post-employment benefits. The calculation should be prudent, not too conservative. As per the standard, the following actuarial assumptions should be formed: demographic assumption, financial assumption. About the future of the current and former employees who are eligible for benefits such as matras, employee turnover rate, this should be considered. This is all done by the expert. As you know, actuary, they have their own institution. So employee turnover rate should be considered, plan members with dependents, claim rates under plan, mortality. In case of financial assumption, these are the demographic. In case of financial assumptions such as the discount rate, future salary and benefit, expected rate of return on asset, medical benefit cost, it should be based on the market rate as on the balance sheet date. What is the conclusion? Actuarial gains and losses comprises of the effects of the differences between the previous and the actual actuarial assumption or the changes in the assumptions. Actuarial gains or losses should be determined by P&L immediately as income or expenses. So if there is any difference, should be considered immediately. Under defined benefit plan, we have to consider time value, present value. So for that we have to follow certain steps. Correct present value. So step 1 should be estimate employee benefit obligation as on balance sheet date. Estimate employee benefit as on balance sheet date. So once you estimated the benefit as on balance sheet date, then discount that one, discount the benefit using the projected unit credit method. Projected unit credit method. Third point, find out the fair value of the plan asset. Point number 4, determine the actuarial gain or loss. Point number 5, determine the past service cost. Past service cost. This is due to change in or introduction of new things in plan. Okay. Point number 6, when plan is stopped, recognize gain or loss. So when plan is stopped, gain or loss. These are the steps. Step 1, estimate employee benefit obligation as on balance sheet date. Then comes discount the benefits using the projected unit credit method, PUCM. Then find out fair value of plan assets. Next, determine the actuarial gain or loss. Next, determine past service cost due to the change or introduction of new things in a plan. Last, when plan is stopped, recognize gain or loss. Other important point is when we use yield of government bonds, we have to use yield of a government bonds as at balance sheet date. In case of fair value, we have to take market value. In case of fair value, we have to take market value. If not available, we have to estimate the value. Actuarial gain or losses should be recognized immediately, as I told before, in P&L. So actuarial gain or losses should be recognized immediately in P&L. And one more thing, based on the market expectation, expect the return on the plan asset. So based on the market expectations, expect the return on plan asset. In the balance sheet presentation, we have to calculate the PV, right? Present value of the defined benefit plan. We will compute the present value of the defined benefit plan. Then we have to deduct past service cost not yet recognized, as I told before. Then we have to deduct fair value of plan asset. How to calculate a fair value of plan asset? Opening fair value of asset minus return on the asset, add return on the asset, add contribution less actual payment to the employee. That will get the fair value. I will write here how to present in balance sheet. Balance sheet presentation. We will calculate PV of defined benefit plan. Correct? Then I said we have to deduct past service cost not yet recognized. then less fair value of plan asset. You will understand when we will do the illustration. This should be the balance sheet presentation. What is the fair value of plan asset? We have the opening fair value of asset, then we have to add return on the asset, then we have to add contributions, then we will deduct actual payment to the employee. This will be the fair value of plan asset. So we will see the illustration. So we have some 6 illustration, I think, given by the ICI. So first, what are the kinds of employees covered in the revised accounting standard 15? Whether a formal employer or employee relationship is necessary or not for benefit to be covered under the standard. First, what are the kinds of employees covered? We studied, we know full-time, part-time, permanent, casual, temporary basis, full-time directors, other management personnel. So that is the kinds of employee covered in the revised accounting standard 15. Whether a formal employer-employee relationship is necessary or not? No, it is not necessary. There is no requirement for the formal. There should be the requirement of employer-employee relationship, but the question asked whether the formal employer-employee relationship is necessary or not. So answer is formal employer-employee relationship is not necessary. So we have to consider several factors in determining the nature of the relationship. As I said, outsourcing contracts that shall not be satisfy the employer-employee relationship. That's why it is out of scope. That will not be included in the AS 15 outsourcing contracts. Then we have contracts need to be carefully examined to extinguish between the difference between the contract of service and contract for service. Correct? Contract of service and contract for service. A contract for service implies contract for rendering service, professional or technical services, which is subject to limited direction control, whereas contract of service implies a relationship of an employer and employee, and the person is obliged to obey the orders in the work to be performed, and as its mode manner of performance is mentioned by the employer. So in the case of contract of service, it comes under AS 15. So that will be the answer for this theoretical question. Next illustration. Whether enterprise is required to provide for employee benefits arising from informal practices. So informal practices are those practices which are not written, which are not standardized, which is not obliged. informally paid by the employer to the employees. So whether the enterprise required to provide, so we have to see whether that is give rise to an obligation where the enterprise has no realistic alternative but to pay the employee benefits. For example, if the employer does not pay the such amount to the employee will not come to work. So it is a general custom of that enterprise, then it is necessary. There is a enterprise has no realistic alternative but has to be pay. That is a one point. Then there is a historical pattern of granting such benefits. That is a second point. There is a third point is expectation is created and the impact on the relationship with the employees in the event such benefit is withdrawn should be considered in the determining whether the informal practice given rise to the benefit covered by the standard. So for example, employer gives a lump sum amount in the Diwali occasion every year, it is a custom, then such benefit should be recognized as to be provided, where the careful judgment should be applied. Careful judgment should be applied in assessing whether an obligation has arisen, particularly in instances where an enterprise's practice is to provide improvements only during the collective bargaining process and not during any informal processes. One more thing, if the practice established by an employer was that of a consistent benefit granted, it is a consistent benefit either as a part of union negotiation or otherwise, that clearly established pattern. Example, cost of living adjustment or a fixed rupee increase, that is a established pattern. It could be concluded that an obligation exists if there is a established pattern is there. Example, fixed rupee increase, then it could be concluded that an obligation exists, that those additional benefits should be included in the measurement of the benefit obligation. So we have four types, right? Employee benefits, short term employee benefits, post employment benefit, long term employee benefit, termination employee benefit. Examples, short term wages within 12 months of the year, and post employment benefits, gratuity, pension, provident fund. Long term employee benefit, long service leave, long term disability benefit. Termination benefit, VRS payments. This is the second illustration. Third illustration, whether an entitlement to earn leave which can be carried forward to future periods is a short-term employee benefit or a long-term employee benefit. This is a good question. EL, how to treat the EL, long-term employee benefit or a short-term employee benefit, earned leave. In short-term compensated absences where the absence are expected to occur within 12 months, that is a very important. It is expected to occur within 12 months after the end of the period in which the employees render the related service, then it will be considered as a short term, otherwise long term. So false due, that is very important, expected to occur as the basis short term, then it will be considered the short term, expected to occur. So expectation, estimation will be done in the case of the EL. I can give example in the case of earned leave. Employee has 100 days of EL, which he is entitled to unlimited carry forward, but the rules of enterprise allow him to encash utilize only 30 days. So employee has 100 days of EL and leave. You know, I hope you know this meaning of EL. He can take the leave, but he will get the earning in earned leave. He will get the earnings in spite of leave. That is called as EL. So if an employee has 100 days of EL, but he is entitled to unlimited forward. Carry forward not limited. Is entitled to an unlimited carry forward, but the rules of the enterprise allow him to encash means utilize only 30 days during the next 12 months. So enterprises rules says next 12 months you can encash 30 days only. So next 12 months 30 days of benefit would be considered as the this will be considered as the long term benefit because he has the leave which can be carried forward. That's why it will be considered the long term benefit. In some situation where there is a no restriction but the absence is not expected to wholly occur in the next 12 months, the benefit should be considered as the long term. That also will be there, no restriction at all there, then it should be considered as the long term. I will give an example for that. Now 400 days, okay, EL of 400 days. So 400 days carry forward only, carry forward of EL. So past pattern indicates that the employees are unlikely to avail and cash the entire carry forward during the next 12 months. Then the benefit would not be considered the short term. So within 12 months entire will not be covered, of course. Then this will not be the short term. So it is necessary to consider EL which falls due. That is a very important term. Falls due. The pattern of actual utilization or encashment by the employees. Although a reflective of the behavioral pattern of employees does not determine the status of the benefit, that is whether short term or long term, the value of short term benefit should be determined without discounting, and if the benefit is determined as long term, it would be recognized and measured as other long term benefits in accordance with the standard. So categorization of short term and long term benefits should be done on the basis of overall behavioral pattern of the employees of the enterprise, not on individual. If one person does like this, no, overall pattern should be considered. So we have to consider when it will be the short term, when it will be the long term. So if the carry forward benefit will be left in long period, that is more than 12 months, then it will be long term. If it is not exhausted, not completed within 12 months, it will not be considered the short term. If it is completed within 12 months, it will be considered as short term. So we will move on to the next illustration. In case an enterprise allows unutilized employee benefits. So in case enterprise allows unutilized and employee benefits, medical care, leave, travel, etc. to be carried forward, whether it is required to recognize a provision in respect of carry forward benefits. Yes, provision should be recognized, whether it is conditional or unconditional, with which an employee becomes entitled to as a result of rendering of the service, and should be recorded as a part of the cost of service rendering during the period in which the service was rendered, which resulted the entitlement. In estimating the cost of such benefit, the probability of employee availing such benefit should be considered. So in this case, whatever the carry forward of the unutilized employee benefit should be recognized in the provision. So we will move on to next illustration. Omega Limited belongs to the engineering industry. The company received an actuarial valuation for the first time for its pension scheme, which revealed a surplus of rupees 6 lakh. It wants to spread the same over the next 2 years by reducing the annual contribution to rupees 2 lakhs instead of rupees 5 lakh. The average remaining life of the employee is estimated to be 6 years. You are required to advise the company on the following items from the viewpoint of finalization of accounts, taking note of the mandatory accounting standards. So in this question they given the actuarial valuation surplus, so actuarial gain. So as we know, when there is a actuarial gain or a losses, it should be recognized immediately. It should not be postponed or carry forwarded. So whatever the actuarial surplus is, there should be recognized immediately in the statement of P&L as a income or expense. In this case, as a income, it should be credited to the P&L for the current year. It should not be spread over the next 2 years. So whatever the 6 lakh rupees should be credited to P&L. Next question. As on 1st April 2011, the fair value of plan asset was 1 lakh in respect of a pension plan of Zelius Limited. September, what they happened, paid out benefit of 19,000. So fair value of plan asset 1 lakh, paid benefits 19,000, received contribution 49,000. Then March of next year, fair value of plan asset was 1,50,000. So we have opening, we have closing. Then the PV, present value of defined benefit obligation, was 1,47,920. Actuarial losses on the obligation was the 11,12,600 rupees. 1st April 2011, the company made the following estimates based on its market studies. Interest, dividend income after tax payable by the fund 9.25%. Realized and unrealized gains on plan assets after tax 2%. Fund administration cost 1. Expected rate of return total 10.25. You are required to find the expected and actual return on plan asset. So in this question they asked two things: expected return on plan assets and the actual return on plan asset. What is the expected return on the plan asset? So we will first calculate the actual returns. For that we need closing fair value of the plan asset. We have to deduct from that fair value of the opening of the plan asset, correct? Then we have to deduct contribution received. Then we will add what is actually we paid, what benefit we paid. Then we will get the actual return on the asset. So actual return on planned asset. Actual return on plan asset. So we need closing fair value of plan asset. Then we will deduct opening value. Then we will deduct contribution received. Then we will add what actually we paid. Then we will get actual return on plan asset. So what is the closing of plan asset, fair value of plan asset? 31st March 12, fair value of plan asset was 1,50,000. So the amount is 1,50,000. Then we will see the opening. On 1st April, little above, yes, on 1st April 2011, the fair value of plan asset was 1 lakh. So 1 lakh should be deducted. Then we have contribution received. Inward contribution we received 49,000. So this should be deducted. This should be deducted. We will get, what is the amount we'll get? 1,000 rupees. Then what is the actual benefit paid on 30th September? That should be added. Then that will be known as the actual return on plan asset, 20,000 rupee. That is the actual return. Next we will move to expected return. For this we have to calculate return on what is the opening fair value of the plan asset. On that we have to calculate return for the 1 year, 12 months. For the 12 months, at what rate? That will be given in the question itself, right? Then any other return is there, we have to calculate. We whatever the we paid should be deducted from the inward receipt on that for whatever the month we held. Here from the opening balance 12, that's why 12 months. Here when the amount received, that should be added. When we paid out, that should be deducted on that return. For how many months at given rate, we have to calculate the return. That will will get the expected return on plan asset. So return on 1st April 2011, so opening 1 lakh for the entire year. So 1 lakh rupees on 1 lakh rupees for the 1 year 12 months at the rate of 10.25. So 10.25 percentage is given, ready-made return is given. So at 10.25 percentage we have to calculate the return. So 1 lakh into 10.25 percentage is 10,250. So next, inward minus paid out. What is the inward received? Contribution received 49,000. What is paid out? 19,000. $49,000 minus 19, 30,000. So return on 30,000 for how many months? It is when 30th September, middle of the year. So exact 6 months. So 6 months, 10.25 percentage. One five 1538. So 11,788 will be the expected. So 2 question they asked. This is the one, expected return and the actual return. So actual return from the closing FE of plan asset, we have to deduct opening FE of plan asset, and we have to deduct contribution received. On that amount we have to add the benefit paid. We will get the actual return on plan asset. In the case of expected return, return on the whatever we had, return on the inward minus outward. This will be given as per whatever the expected return. Okay, we will move on to next question. An employee Roshan has joined a company XYZ Limited in the year 2011. The annual emoluments of the Roshan has decided is 14,90,210. Okay. The company also has a policy of giving lump sum payment of 25% of last drawn salary. So we have to find out what is the last drawn salary for each completed year of services if the employee retires after completing the minimum 5 years. Okay, the salary of the Roshan is expected to grow 10%. So this into 10%, that is 110% every year. So into 110 into 110 into 110 into 110 into 110. So expected last drawn salary after 5 years is 24 lakh is correct. So what is they are giving 25 percentage of last drawn annual salary of employee for each completed year. So he completes 5 years, so 25 percentage into last drawn salary into 5. So this is the expected last round salary, 25 percentage 5 years, 30 lakhs. This is the defined benefit obligation. What is asked? The company has inducted Roshan in the beginning of the year and it is expected that he will complete the minimum 5-year term before retiring. What is the amount company should charge in its P&L? That is simple, 30 lakhs divided by 5, 6 lakh each per year. Amount of 6 lakh will be charged to P&L. Okay, next question. What is the amount of the company should charge in its P&L account every year as a cost for the defined benefit obligation that is over? Also calculate the current service cost. Current service cost we need PV factor. So for each year we will calculate based on the PV factor current service cost. So 6 lakhs, 4 more years to go, so this PV factor will be used. 6 years, 3 more years to go, 2 more years to go, 1 more years to go at 1. So this will be the current service cost. 6 lakh equal apportioned amount of benefit obligation. Simple. Next is asked interest cost to be charged per year assuming discount rate is 8%. Then is very simple. Whatever the asked into 8%. First year 0, same amount. Next year into 8% we will get. We have to add it back. This plus this here, and this is total of BCD 9 lakh. Say will into 8%, same thing will apply at the end. We will get current service cost of 6 lakh. Correct? So total 30 lakh. Due to approximation used in calculating this figure adjusted here. Okay, so this is with regard to the accounting standard 15. Thank you.